ASX-listed uranium companies are up 26% for the last month. We've got some of these companies ranked 37th for momentum and 51st. That's Peninsula, Energia, and DYL. But the real kicker is not necessarily the momentum. It's that uranium is ranked number one on the Launchpad as a theme. So the Launchpad is where the companies with the best momentum improvements this week are sorted out. Uranium ticks that box, number one pole position. That's often a precursor to that whole theme and all the constituents, or a lot of the constituents, becoming market-leading companies and momentum leaders. So having a quick look at the top 6 from a Launchpad perspective, we've got them on screen here: AGE, Peninsula, EL8, Bannerman, Lotus, and DYL. But today we're talking about the momentum leaders, not the Launchpad leaders. That just gives us an indication that there's something boiling under the surface and there's great opportunity ahead. It takes us into the commodity price, which with any group or thematic that we look at, if there's a commodity, we want to understand what's happening in the spot market. But uranium is quite interesting at the moment. We need to understand the spot, middle term and long term markets because the demand curve is changing dramatically and in a short amount of time. First off, we start with the spot prices. We're looking at the uranium price, which is the yellow line on the chart, and then the global ex-uranium ETF. Think of a basket of uranium exposed companies boiled down into one number. That's the blue line there. Massive divergence. In the last 12 months, we can see uranium prices stabilized and started to kick up in the last few months. We're still seeing stabilization occur in the listed companies, the ASX listed, internationally listed companies that are in the uranium space. This creates opportunity. Uranium prices going up, but the share prices haven't yet followed suit. If you remember coal, it's reminiscent of that market. Let's have a look at the coal prices for a bit of a quick history lesson. Seeing divergence here in 2020, 2021, we've chosen 2 indicators here. We've got the coal price itself. That's the underlying commodity, much like uranium. And then Whitehaven Coal, one of Australia's largest coal mines, ASX listed, great pure play coal exposure if one wants to trade coal. Using a baseline here for 100, when they both enter the chart on the left-hand side, they're sitting at 100. So this shows us the price differentials or the performance differentials over that period. You can see the blue line increases towards the end of 2021. What happens here is that in the middle of 2021, we should say, June, July, which is about 12 months ago, 12-month windows, we should say. Middle of June, July, we've seen that it's increased by May about 175%. At the same time, Whitehaven Coal is exactly where it was 18 months earlier. That's the divergence that we're looking for, because when you play catch up, we can see these commodities fire on, continue in their trends, which commodities are known for, and we can see that there's a lag in the movement of the share price. Could be happening with uranium. Let's see. Now we have a look at this Sprott physical uranium ETF. Good place to look if we want to understand what's happening in the markets. Very liquid, and we're seeing price discovery all the time. You see in the last couple of days a huge shoot up with good strong volume. That's something to keep of interest. We're seeing a lot of traders move in there, so something's happening. The Sprott Uranium Miners ETF shows something else. Coming down off a base though, this is critical because if we're trading, we want to be looking for false breaks, springs, and that kind of thing. Without delving into too much detail here, we do see a false break and a spring, quick reversal, good solid volume, positive movement for Sprott, the uranium miners. Now we look at the junior uranium miners, a newer listing showing less of a history to the left-hand side, but we see a similar pattern coming down off the lows, huge volume, big reversal, retesting these lows, spring, false break, and then quick recovery coming back up to recent highs, retesting them right at a point of resistance, inflection right here. So we also need to understand what's driving this. And that's where we have a look at the global supply, the constraints with supply, and the changes in demand. First off, the world uranium mining production. We've got this for 2022. We're still halfway through 2023, so we won't have those numbers for some time yet. But they were updated just last month. We're looking at numbers from 2013 through to 2022. Australia's ranked number 4. In 2013, we were producing 6,350 tonnes per annum. Now we're over 4,000. We've dropped, but that's not uncharacteristic of the rest of the uranium production in the globe. Have a look at it. 2013, 59,000, all the way down to 48,000 today. That sits at 74% of the world's current demand. there's a problem here, because clearly if we don't have enough supply to meet demand, we're not going to produce the energy that we need. There are other supply mechanisms coming through other than just digging it out of the ground. That's a whole other podcast in itself. But what that does help is take us to the understanding of the demands and how that's changed. We all remember Fukushima, and that really became a turning point for lack of investment in this whole region, from a mining perspective all the way through to decommissioning nuclear facilities. What's happened is we've seen a complete 180. We're now, after some of those facilities have been announced as decommissioned or having an end-of-life situation that might be 2023, 24, 2030, complete reversal. Governments have now said, hang on, we were going to decommission that. We need it. It's greener, it's cleaner energy. We want that energy. Those facilities that were being shut down were running down their supplies, running down their inventories, and were not participating in the global market to show their hand for demand because they didn't need any supply in the medium, short, long term. They were running their facilities down. That's the short-term supply suddenly kicking up. That shows up in the spot prices. Now we look at medium term. We're going out a few years. Projects that were going to be decommissioned in 5-10 years' time. They were told back in 2010, 2015, we saw a whole government shift saying we don't want nuclear, not in my backyard. Now we're greener and cleaner. That's been changed. That 180 is happening, but it's not just happening for projects that were mothballed, those that were planned to be in 5 and 10 years' time. For Australians, think of coal mines that kept getting pushed out further and further. They still need supply to generate the energy. So they're participating in the medium-term markets, and they're asking for supply 2, 3, 4, 5, 10 years from now. That takes us up to the longer-term facilities. It can take a uranium facility, a nuclear facility, 10 years to get up from scratch, and then participate in the markets, the global markets, asking for supply. They bring that demand and want to be supplied. That takes us to the longer-term part of the curve. So we're seeing short, medium, and longer-term demand sides all inflating at the same time. That comes down to impacting the companies that can supply it short, medium, and long term. That brings us to the top 6 momentum companies on the ASX in the uranium space. Looking at number 6, we've got NXG gaining 17% over the last month. Devex Resources, 18% gains. BKY takes out 4th place. Berkeley Energia, 19% gains. Moving into the top 3, looking at Bellavista Resources, BVR, 20%, Silex Systems, SLX, 24%, DYL, one of the top 51st ranked for momentum across the whole ASX at the moment, 26% monthly gain. So if we look at BVR, we can see the mine site here, and we're going to understand on the chart what's happening. We've got a disconnect. The last couple of days, we've seen uranium prices. We saw Sprott, we saw the physical, we've seen that momentum kick up. They're not participating. So what's going on? Digging down in the surface, we see that they're actually out there promoting the market in investor presentations on the nickel and copper front. So they're out there on a roadshow, wearing out the shoe leather, pressing the flesh, stoking the fire that's nickel and copper. So this is not running off the back of uranium, even though they do have facilities. Bit of a misnomer. However, the other two aspects, the other 2 leaders ranked 1 and 2, very different story. If we look at Silex Systems, share price shows a stronger correlation with what we saw with the Sprott, the uranium prices, and what we would expect. There's a bit more volatility going on here, but a good increase in demand that we're seeing in June that we haven't really seen for quite some time. Silex Systems describe themselves as an Australian high-tech company focused on the delivery of the unique and disruptive Silex laser enrichment technology as the next generation technology for the global uranium enrichment industry. Sounds pretty cool. They have a few other irons in the fire: isotope separation technology through lasers, laser enrichment, and production of quantum computing materials. We want to understand where they sit, so we've got to understand a little bit of history of the evolution of enrichment technology. First generation technology is gaseous diffusion, very low efficiency, high cost, some obsolete. Second generation technology, we're talking about centrifuge, which is the current technology, lower cost, modest efficiency. Third generation, next generation, the future of uranium enrichment, as Silex say, is using Silex lasers, highly efficient, anticipated to be lower cost. Now, the overview takes it back to Silex being invented and developed in Sydney during the 1990s. Go Lucas Heights, if you've ever driven out there, we drive past it often. The uranium enrichment application But the Silex system is a joint venture. Global Laser Enrichment has kicked off, licensed exclusively to Global Laser Enrichment in 2006. And today that's owned 51% by Silex and 49% by the industry giant Cameco. What we want to understand here is this joint venture. We're talking about supply here. We're talking about enrichment, which has been a great concern because after the Russia-Ukraine war, we've got an ESG issue. 5 years ago, it was less of a concern for uranium. It was low price, supply it where you can, produce the energy. ESG concerns have come to the forefront. Geopolitical concerns are also coming into the mix for where uranium is supplied from. This is critical because we've got a joint venture here in the US side of things. They're looking for the first planned commercial facility to be enriching facility in Paducah, Kentucky, looking to produce up to 2,000 tons of natural UF6. That's about a 30-year life they're looking for on that project. This is critical because we're looking for supply from the West. Supply from Central Asia, supply from Russia now comes with strings attached. If the price is lower, doesn't necessarily mean that the governments are willing to buy it because a lot of the facilities that are the end consumer of uranium are government facilities. That makes it hard. So it's a benefit for ASX-listed companies such as ones leading technology. It's a bit of background on the technology coming from Silex Systems and Silex Technology, where they are today. They see themselves as having opportunities in the uranium production, conversion, and enrichment side of things. That's where the market they see themselves sitting in. And also working with the US is a great marker because it gives them the facility or gives them the scope to work with US and Australian companies because there are conditions that need to be met from security provisions, defense mechanisms, because we're also looking at supplying defense craft with the supply of uranium as well. So there's a lot there that's behind closed doors. When we look at uranium enrichment, it's also a good understanding to have because naturally occurring uranium is dominated by two isotopes, U-235 and U-238. Nuclear energy is produced by splitting or fission of the U-235 atoms. So natural uranium is made up of 0.7% of active U-235 isotope, with a balance 99.3 made up of the U-238 isotope. Uranium enrichment is the process of concentrating or enriching the U-235 isotope up to 5% for the use as a fuel in a conventional nuclear power reactor and up to 20% for emerging advanced small modular reactors, SMRs. Enrichment is a technically difficult process and accounts for around 30% of the cost of nuclear fuel and approximately 5% of the total cost of the electricity generated by nuclear power. The separation of isotopes by laser excitation, Silex, S-I-L-E-X, Silex process is the only third-generation enrichment technology at an advanced stage of commercialization today. It is able to efficiently enrich uranium through highly selective laser excitation of the fluorinated form of uranium, the 235 UF6 isotope molecule. The two methods of uranium enrichment used to date are now obsolete. Gas diffusion technology, first generation that we looked at, and gas centrifuge, second generation. It's the current market. Silex's third generation laser-based process provides much higher enrichment process efficiency compared to these earlier methods, potentially offering significant lower overall costs. Great positive when there's huge demand and lack of supply. Now we move over to deep yellow. Looking at the chart, we're seeing a similar thing. High correlation with that movement, except they've bolted out. They've broken out of overhead resistance. They've done it with sort of a cup and handle formation, but then a spring, a retest, and massive volume in the last 4 trading sessions. Huge volume, very positive to see. Looking at their facilities, there's some great pictures that we've been able to add in here, but deep yellow, DYL is the ticker, they're Namibian focused, they're advanced stage uranium exploration company. Remember that word, exploration. So we're looking longer term, medium to longer term supply here. Deep Yellow's operations in Namibia are conducted by its 100% owned subsidiary, Reptile Uranium Namibia, RUN for short. They own 100% of 2 EPLs covering large aspects of Namibia in the Nafulka Desert Park inland from Walvis Bay in the south and west of Paladin's Langer Hierarch mine. Now, the capacity is aiming to produce 10,000 million pounds of uranium. Geographically diverse exploration sites that they're looking at in these two advanced projects. Now, they're possibly going to have a 30-year life of mine project for the Tumas aspect. Now, Tumas, they're looking for some coming key works that will have the final investment decision by the first half of 2024. Some great pictures here of their operations. And we're going to round out with looking back again at the launch pad, because this is seeing Deep Yellow ranked number 6 in the launch pad at the moment, 51st for the whole ASX momentum, but doing very well from a launch pad perspective, which can be a precursor to, again, something like what we saw here. If we round it out by looking at the coal prices to understand this is the type of thing that can happen. And we want to be looking at the leading companies, sectors and themes that can be doing this. I'm Christopher Hall. This is Finer Market Points, where we connect the leading market themes and top performing companies for better trading.